Yeah, also guys, welcome to another tutorial. So in this video, we're going to be talking about types of entry. And when I say type of entry, I'm talking about types of candlesticks pattern or chart patterns or market structure stuff that you need to see that will tell you that, okay, this is the time for you to take a trade. So um, there are actually a lot of them that I use. If I should categorize them, I think I would say like there are like four types of them. So I'm just going to list them out. Then I'm going to break down two. Then maybe in our subsequent videos, I'll still talk about the other ones as well. I think they're actually up to five, but I'm just going to talk about list four here. Then we'll talk about two briefly. Now, um, one of them, right, which is the most popular, and that's the one I want to talk about um very much well in this video, which is CISD. Now, CISD simply stands for change. You can also look this up on YouTube to get more info. Change in state of delivery. So the very first type I use is what I call change in state of delivery. This is the one you hear me talk about a lot on some of my YouTube channels, YouTube videos. So CISD. Then there's the second one, which is market structure. Market structure. So talking about market structure here, it can either be, let's say, change of character, or it can be breakout structure, depending on where you are taking the trade from. Um, then the fourth one can be chart patterns. Chart patterns. Chart patterns can be wedges, right? It can be channel, can be channel, channels. It can be double top or double bottom. Now, the fourth one is an engulfing candle. Now, CISD is a little bit similar to engulfing candle, but there's a difference. So maybe when I talk about engulfing, then I'll tell you guys the difference in both of them. So these are four types of entry, right, that I normally take whenever price gets to a point of interest. So in our previous video, we talked about points of interest, and I told you guys that point of interest simply means that the level where you're anticipating price to retrace to for you to take a trade. For example, as you guys know, this week we didn't really have much smooth with our pairs, namely gold, AUD USD, Euro USD, and BTC, because price didn't really retrace to their points of interest. Like for example, Euro USD, we took a trade, which is the one I'm going to be using for the example on this lecture. We took a trade somewhere here on last week Friday, and closed it and reopened it and re-entered it on Monday, and it rallied. Now you can see that price from Monday, as you can see, this is Monday over here, right? From Monday all the way down to today being Friday, price did not get down to the golden zone or the point of interest itself. Remember, the reason why I combine golden zone and points of interest, like I've told, I think some of you guys last year, is because sometimes price don't normally will not always get to the other block, that's the point of interest instead, or the demand zone itself. Sometimes it might give you setup around the golden zone, so that's why I combine both. So if I don't see the setup forming inside pure points of interest and I see it inside golden zone, I trade. In fact, this particular trade we took over here on Friday that rallied was actually a golden zone trade. It didn't really retrace down to point of interest. Now, if you look at this area over here, right, don't worry, guys. I just want to break things down so that you understand, get the whole picture of what I'm trying to show you in this video. So if you look at this whole zone over here, you see this is the 4 hour time frame. I remember I told you guys that 4 hour time frame is the best um hour time frame to mark points of interest. All right. Especially when the market is choppy or when there's a lot of displacements in the market. That's when we'll have massive moves like this. So you can see that price did not come down into the point of interest itself. If on a normal day it's supposed to tap at least the edge of the point of interest, but you can see that it didn't come down into the point of interest. It did this came down, took out this liquidity over here and rallied. Now um the entire aim of this particular tutorial now is to show you what to look out for in this particular zone. All right, and if you map out of Fibonacci, you will see that that zone was around the golden zone over here, so it didn't really tap into the point of interest. The thing is that once price taps the golden zone, you start looking for these things that I'm going to show you in this video. So, and that's what I listed in this place: change instead of delivering, market structure, that is a break of structure, change of character, then chart patterns and a graphic candle. Sometimes they all form together, right? Like meaning first, like sometimes you might see markets going down, forming wedges, and inside that wedge you might start to see engulfing candle. Yeah, something like that. So let me just sorry guys, so let me just remove this other trend points of interest. Now the trade we took here, right, took this trade somewhere around this area over here. Took this trade somewhere around this area. Stop loss was zero. I think we got out of this trade as 1.19. Yeah, well, I can remember clearly, 1.19. So this is where we got out of this trade, which is more than 1 to 2 risk to reward. Now what first of all, let me break down the change instead of delivery. So this CISD simply means, let's say for example, we have a point of interest somewhere around this zone, right? And price rallied from that zone, making it a demand zone. Now we're waiting for price to retrace down into this level, and then we will take a buy, right? So what changes state of delivery does is that when price is retracing down, there's most likely going to be some liquidity, all right, both external and internal. Now internal is like FEG, um previous day low or previous week low or previous session low, that we might have over here that price is going to take out. Now if price takes it out, right, and gives you a bullish, let me just use the chart so that's because what I want to explain here is not going to be that easy to explain with just a sketch. So let's go to the 1 hour time frame, which I use mostly for my entries, to see what we saw there that made us take that trade. So the trade signal was given somewhere. I think the trade was given somewhere here, but the setup, the entry itself came up here. But the reason I had to wait for price to push up a little bit was to confirm that this whole area was secured. So I'm just going to use this area as an example. Now, what happened here, right? So this is the point of interest. This was the retracement into the point of interest. Now, while we were waiting for price to tap the point of interest, right, we had liquidity sitting below this level over here. We have this equal lows. Now, this could be lows from previous session. It could be previous day low. As you can see, this trade was on Friday, right? And this is Monday, this is Tuesday, all the way down to Thursday. So there were stop losses sitting below this price level. So what price did was that price came down, right? Took out this stop loss over here, then went up. Now, where I want you to pay attention for you to identify a CISD, this is what a CISD looks like. CISD is when you have a bullish CISD in this case now. Sorry guys, I have a position, so that's why I'm kind of looking at the watch list. So in this particular zone over here, right, we can see price coming down, right, taking out all this liquidity over here. Now, pay attention to this, the last bearish order block, right, is what you should be looking out for price to close above it. I'm talking about the bullish scenario now. Now, in this particular zone over here, where do you have the last bearish order block? that took out these liquidity over here. This is the candle over here. This is the candle. This candle. That's the last bearish order block. This is another bearish order block. That's why I told you guys that I waited for price to close above this level before I gave that signal, because I wanted you to close above the second, just to get that confirmation that okay, it's just like a double confirmation, right? But the first confirmation came from this zone. So what a CISD formation looks like is once price goes back to above the last bearish order block that took out liquidity, not just any bearish order block. Like for example, we have bearish order block here, we have bearish order block here, we still have a bearish order block here. But as you can see, it was none of this order block, none of them took out this liquidity. All right, it was this particular one over here. This one came down, took some of this out, but didn't take this one out. So it was still valid as well. But as you can see, price did not go to close above it directly. It came here, created another bearish order block, came down, took out these liquidity over here, then came and closed above it. Once it closed above it, this particular candlesticks formation, this entire um formation over here is what we refer to as change in state of delivery. So in summary, what change CISD simply means is that once we have, let's say for example, we have liquidity, right? Let's have external, it can be external liquidity, it can be internal liquidity. So once price takes out that liquidity, I'm talking about a bullish scenario now. Once price takes out that liquidity, all right, and it takes out that liquidity and creates, let's say, a bearish order block, and that bearish order block pushes down, pushes, it can be multiple times, but well, if it takes liquidity, then if you see price coming to close above that order block, that particular formation is what we call a change in state of delivery. That simply means that the banks, right, the banks, that they are now ready to change direction of the market, or whoever is in control of that market is now ready to change direction of the market. That is what a CISD simply means. Now I'm also going to show you a couple of other examples. So let's also use this area as an example. So as you can see over here, right, this is on 1 hour time frame now. So we have this zone. This is actually an order block. When you see aggressive movements like this, then a little retracement, then another aggressive movement, always mark that zone 2 as an order block. For example, in this particular case now, you will be correct to say that we have 2 points of interest, right? So but we're going to be referring to this one because that's where price reacted to. So now as you can see over here, we had this fair value gap, right, which is also internal liquidity. Now this is what price did. Price came down, right, tapped into, came down, created a kind of liquidity over here, did not tap into the points of interest. Now, this other candle, it went up, created an order block. This is the order block, bearish order block. That's this candle over here. That's this candle over here. So in this case now, after creating this bearish price came down, took out this liquidity, tap again into the points of interest. All you are waiting to see, that's why I normally say something like the neckline or the handle or that kind of, those words I normally use. It all boils down to what I'm showing you right here now. So once you see price coming, closing above it now, as you can see, price after taking out internal liquidity over here, came back and did what? Started trying to close above the bearish order block. As you can see over here, once it closed above the order block, if you are taking a trade, this is where you should take your trade. Now, your stop loss should always be below the candle, the move that created that CISD. Because in most cases, price is not going to come down to take out this low again. Where price is going to be aiming for, that's why it's called a change in state of delivery. Price delivery will now change direction. So what price is mostly going to do most times is to aim for either this high or this fair value gap. So that will now give you a potential 1 to 1 or 1 to 2, 1 to 3, depending on where you are targeting. So don't take a trade, like for example in this case now, and put your stop loss here. No, always make sure that your stop loss is below this level. Now you can wait for retracement so that you get a better risk to reward. But for me personally, like I always say, I don't wait for retracement because it's not every time that the market is going to give you opportunity, you know, give you that retracement. Because if let's say for example you waited, and based on the fact that I use the 1 hour time frame, sometimes I wait for a day or two for a setup. So imagine you waiting for 2 good days for a setup and missing that trade just because you are waiting for price to just because you're waiting for price to give you a retracement after it has given you CISD. So in this case now, I just take the only thing I try to make sure is that my risk, I risk the exact amount. I risk the exact amount that I wanted to risk in this particular trade. So whether there's retracement or no retracement, for example, if I'm risking 2% of my account, I make sure that whatever I'm taking this trade, I'm risking 2%. The only thing is that, let's say for example, if I get an entry over here, right, I might use, let's say, 0.2 lot size, right, or zero point 0.1 lot size, right, so that stop loss will remain, let's say, 1%. Now if I happen to get an entry somewhere here, then I'll now use 0.2 lot size, right, then I'll still use this, I'll still risk the same amount in dollar value. So that's just the difference. So trying to wait for retracement for me personally is just you trying to add some kind of perfection, but there's no perfection. Once you see that change in state of delivery, you take your trade. Now let's also see another setup over here. Here we have another point of interest. Now this works in every time frame. Now your entry time frame, or the time frame where you are looking for your change in state of delivery, depends on the time frame that you mapped out your points of interest. I will explain that as well. Now you can see in this case, price rallied. This was demand zone, which is points of interest, created all this liquidity, then came down, took out this liquidity. Now, where is the last bearish order block that gave this movement, that took out this liquidity, then tapped into points of interest? This is the order block. This is the bearish order block over here. So all you are waiting in this scenario now is just to see a close above this bearish order block. So as you can see, once you saw that close over here, in this case we had a retracement, but even at that, I would take my trade here. My stop loss will be below this area, maximum 1 to 2, and boom. So that's basically what the change in state of delivery is all about. So now I told you guys something that don't worry, I'll still explain this one. There's a difference between engulfing candle and change instead of delivery. Now they're a little bit similar, but the only difference is that change instead of delivery, you have to consider liquidity being taken out. So but engulfing candles are not like that. So but when we get there, we'll explain that better. So the second one I'm going to also talk about in this session is using market structure for your entry. Now there is secrets I want to let you guys know in this video, right? I already have like 2 minutes in this particular session, but I'll create another one to explain the market structure. Now, CIA is equals to change of character and breakout structure. Now, it depends on the time frame. Now, if you have a 1 hour CISD, what I'm telling you now is you're not going to see it on YouTube or anywhere, but it's something that I've noticed over several months of using this particular CISD. That it is my most used form of entry because it is more reliable because of that, for the fact that it sweeps liquidity before it creates it. So 1 hour CISD is equals to 15 minutes change of character or 15-minute breakout structure. I'm also going to explain that once I get to market structure. So see you in the next video.